If that happens, then we have a severe recession.
Cathie Wood just explained what has to happen for a severe recession to start and whether the recent collapse of the 16th largest bank in the US is going to start the next market crash. So let's take a look. I like Cathie Wood, so I'd like to hear what she says.
During 2020, there was a huge amount of stimulus, as you will all remember. And many banks had incredible inflows, deposits, and both Silvergate and Silicon Valley Bank were two of them. Now, what are they going to do? Well, Silvergate really didn't make loans. So it bought securities, liquid but long-term oriented securities, fixed income. And you'll see that Silicon Valley Bank did that as well. Silicon Valley Bank, which went under, took all that money, and if I remember, it was in the $70 to $90 billion range.
The Wall Street Journal says Silicon Valley Bank ended the first quarter of 2020 with just over $60 billion in total deposits. That skyrocketed to just shy of $200 billion by the end of the first quarter of 2022. So a massive sudden explosion, and you have to do something with that money. You can't just leave it and let it do nothing.
And put it into these long-term instruments to earn a higher yield than in the money markets. At that time, money markets were paying maybe 0.5%, and they got 1.6% on average on that money.
And that seemed to be a great deal. You are making 3 times more than normal. Who wouldn't take that deal? Well, most banks wouldn't, but not Silicon Valley Bank.
Now, the assumption they were making is that interest rates were not going to go anywhere anytime soon. And of course, that has proven to be wrong.
That was catastrophically wrong. Betting on interest rates like that, absolutely irresponsible for a big bank like that.
Interest rates have gone up, I think it's 20-fold in less than a year's time. That has never happened before. And I hearken back to 1981, when Volcker was trying to squeeze inflation out of the system. He took interest rates up 2-fold, from 10% to 20%. True, a high level. But the shock, already people had gotten used to interest rates going up, so they were preparing for it.
I have to push back against that. Okay, so let's look at the interest rates. Throughout 2021, they were basically zero the whole year. But if I look at average 30-year fixed mortgage rates, specifically for 2021, it was 2.65% in the US, and for 2023, 6.5%. And the average price of a house right now is about $350,000. If you get a mortgage at 2.65% on a $350,000 house with a 20% down payment, your monthly payment is going to be $1,100 roughly. And now we take 6.48%. And the same house now is going to cost us $1,766. And that would be 56.5% more. But then, for example, if you, let's say, go from 10% interest rate, where you will now pay $2,450 for that same house, and we go from 10% to 20%, you're now paying $4,700 almost. In this scenario, you're paying 90% more when interest rates double from 10% to 20%, compared to interest rates for consumers went from 2.65% to 6.5%, which is about a 2.5x between these two, but you are only paying 56.5% more on your 30-year mortgage instead of 90% more. What matters is the final number. How much more are you actually paying? I really don't buy Cathie's argument here that a 20x increase in interest rates recently is so much worse than the interest rate increases before. When I look at the numbers, it just doesn't make sense. The actual difference for the end consumer and most people is actually less. Of course, it is unexpected for many, but still it is less. Oh yeah, looking back to 1980s, the rates were scary.
So the shock from going from 10 to 20, there was some shock value, but nothing like we're seeing now.
Only if you are irresponsible with your bets.
And here are some of the ramifications. Now, many people, in comparing to 1981, they say, well, the yield curve is the same as it was back then. And my answer to that is an inverted yield curve of 100 basis points when long-term treasury yields are 4% or less. That's like a 25% inversion if you're trying to measure it, get a sense of sizing it relative to 1981.
Right here, I can agree that it is more appropriate to look at the percentage, which may indicate the likelihood of a recession better, because you look at that total percentage of the inversion, that makes more sense in this case to me.
So 100 basis points over 4%, 1 over 4, 25%. If you go back to 1981, that 100 basis point inversion was against 15% interest rates. So that's more like 6 to 7%. So I would submit that this is sending 4 times the signal that inverted yield curve sent in the early 80s.
And looking back, you can tell pretty much almost perfectly when we had recessions if you just look at the inversions, when shorter term bonds pay you more money than the longer term bonds, which seems ridiculous, but actually it's not if you read into it. Yeah, recession right here, recession right here, recession here. Works like a charm. Except it's not that simple, because if it was, then the biggest hedge fund, Bridgewater, run by Ray Dalio, would easily beat S&P 500, which is the market. As you can see, basically the end result is zero difference, except you will be paying a lot in fees. The only real difference is you will experience a much smoother ride than the market. That's all.
What happened, deposits left, and it was forced to sell securities, which it was holding at a loss. And these are held to maturity securities, which those losses don't really show up unless they're realized.
And they had to be sold at a fire sale price, and that's when the whole thing started to collapse. The bank tried to issue more stock to raise capital, and the market absolutely rejected it. No, said the market, you are going out of business. And that's when the bank run started.
I do believe that with the banking failures that we are seeing, Silvergate Bank, Silicon Valley Bank, and there may be a few more regionals, but we do not think this is a systemic banking problem. We do think it will cause a different kind of conversation at the Fed.
So that would be good news if you believe in Cathie Wood. There shouldn't be a huge chain reaction from Silicon Valley Bank that would bring down the whole economy. Looks like perhaps just an isolated incident. Maybe there are a few small banks that may have similar issues, but doesn't seem like a systemic issue. That's what Cathie thinks. But she does have a few ideas that she shared in terms of what could possibly lead to a recession. So let's take a look at those. But the Silicon Valley Bank collapse, it would appear to me that Cathie seems that almost as a positive, because the interest rates are much more likely to be cut now. And if these do come down, then all of the growth stocks and technology stocks should rally again. In other words, bad news here could actually be good news. And that was exactly the reaction from the market on Friday. Tesla stock actually went up a little bit because it's a growth stock, although most other stocks did not, including technology stocks. But that also signals Tesla perhaps is much more resilient to a recession. Not just the company, but perhaps the stock also. Although probably the stock would not be that resilient to a recession, but the business, yes, I believe it would be very resilient.
If money growth on a year-over-year basis is negative, there is an equation out there in economics called MV equals PQ. Money times velocity equals price times volume. Now, if money and price times volume is GDP, nominal GDP. So if money is going down, what is keeping nominal GDP from going down? It is an acceleration in the turnover of money. And that usually happens in risk-on situations where confidence is very high. And it sometimes happens out of necessity, which has happened very recently. Now, the concern here is that this banking crisis, I would call it a mini crisis, is because of muscle memory associated with the crisis in 08-09, is going to cause individuals and corporations to slow things down a bit, not take that extra risk, make sure they have a big enough capital cushion.
I have been doing that with my businesses too, except when Tesla stock dropped in December. I made an exception. I picked up some more Tesla stock, but overall, what she's saying is actually what is also going on. But I am very careful, and there are many people that are not that careful. They like to live on the edge. I hate that. I don't do that. So I don't think that applies to everyone, but certainly you will find many people that will be more conservative. Like Elon Musk, he laid off some people in like June, and GM only now is starting to lay off more people.
And then there's another thing that might be causing that. The student loan moratorium, it looks like it will end in June. So in July or August, the consumers that have been enjoying that moratorium will have to turn around and start repaying those loans. In preparation for that, they might be slowing down purchases.
That does make sense. Although most of the student debt, of course, is carried by younger people, or at least a good portion of it. This right here is 25 to 34, and then here is 35 to 49. I would assume that people that are older will usually be more responsible and actually do what Cathie just said and will prepare. But the people that are younger, they are more likely to live in the moment. And 70% of millennials are living paycheck to paycheck, report says. So if you're living paycheck to paycheck, I don't think we can really save money. But I think Cathie does have a point here.
That this idea, money going down, if velocity also goes down, so the rate at which money turns over because people are becoming more cautious, want to build their cash cushions, if that happens, then we have a severe recession.
Here's what all of this noise is making me think and feel also. I want to save more money. I want to have a bigger cash cushion, but at the same time, I see a bank go out of business. I don't want to keep much cash in it because that cash could just disappear. If you are just an individual, it's not really a problem because you probably don't have that much cash. But if you run a business, I mean, a very little amount of your money is going to be insured by the government. So it's a little bit harder to keep cash. On one hand, you want to be conservative and you want to build up your cash. On the other hand, if you do that and there is another bank run, you lose all of your cash, or most of it, at least the part that would not be insured. Or another alternative is go and open more accounts with different banks and then pay these high fees and then have your margins lowered. And generally, if you have a business, you bank with one bank because they just offer you much better terms. But they make you sign these documents. Oh, you have to only bank with us exclusively. There's this dilemma that you face. Overall, though, Cathie Wood does not seem to be worried about a recession. She just thinks, it appears to me, that the chances for interest rates to be cut are now higher because of this collapse of Silicon Valley Bank collapse. Because high interest rates have now broken something, and potentially there could be a few other regional banks that she thinks might also suffer a similar fate or a similar problem. And what do I make out of all of this? Will everything really go smoothly and this bank collapse not affect anything at all? Maybe there's something that already started that we don't know about yet, a chain reaction. Maybe we don't know yet. If we do have a huge crash in the near term, I am ready. If we don't, I am happy for everyone because many people will keep their jobs and life will go on. So either way, I am prepared for the absolute worst, but I hope for the best. And this is the Tesla stock buying opportunity explained by Elon Musk. My name is Matt Post. Just like and subscribe if you haven't yet, and I will see you in the next video. Thank you so much for watching.